This educational seminar on investing is brought to you by the Pension Research Institute. PRI was founded in 1971 at San Francisco State University by Dr. Frank A. Sortino. When he retired in 2000 as Professor Emeritus in Finance, he was allowed to convert PRI into a private think tank. This program will present a new approach to investing for retirement. Subsequent programs will examine investing for other goals, such as college education or endowments. You can send your requests for future subjects to www.pmpt.me. It is now my pleasure to introduce your host, Professor Sortino.
Welcome to our seminar. We have some special guests for you who will shed some light on the subject of investing for retirement. My first guest is the former executive director of the City and County of San Francisco Retirement System, Claire Murphy. Our final guest will be Professor Sam Savage from Stanford University. He has written an important book titled The Flaw of Averages. If you are only going to read one book on interpreting statistics, this is the one I would recommend. But first, let me give you my perspective on evaluating investment advice. Some people may claim there's no risk in petting wild animals. Others may tell you that hedge funds are less risky than investing in the S&P 500, and you make a lot more money. Still others may claim there's a riskless asset out there for your 401k plan, like T-bills. My belief is they don't know how to measure risk. Risk of what? To answer that question, you have to ask, what's at stake here? The risk of petting a rhino is not the same as investing in highly leveraged hedge funds. And the risk of investing in T-bills is not obvious. The risk involved in investing for retirement is that you will not have enough money at retirement to provide the income you will need. Replacing income is the goal. That's what's at stake. So why not put it all in T-bills? Eliminate uncertainty. Well, since the return on T-bills will guarantee failure to achieve your retirement goal for 99% of you, it is not riskless. True, it would eliminate uncertainty. You would now know with certainty you'll never have enough money to retire on. Hopefully T-bills are free of default risk, but that's not what's at stake. Later I will present my ideas on how to measure the real risk of investing for retirement. We operate in a world of uncertainty. There isn't any knowing what shock is going to occur in the world, or how that shock will affect financial markets. But there is a professional way of managing that uncertainty. The beliefs that financial experts have are based on assumptions about how to describe that uncertainty and what you're trying to accomplish financially. So you need to be aware of their assumptions before you accept their beliefs. Don't worry, you don't have to know how to interpret this picture. Only that it represents the work of two Nobel Prize laureates, Dr. Harry Markowitz and Dr. Bill Sharpe. This is the model the vast majority of advisors currently use. It was the first attempt to quantify risk and show a trade-off between risk and return. Their theories are jointly referred to as MPT, or Modern Portfolio Theory. It was a great advancement 60 years ago. The fundamental assumption of MPT is that everyone wants to make as much money as they can, subject to the amount of risk one can tolerate. So if you were to tell them you have $100,000 in your 401k, and your goal is to replace 70% of your salary at retirement, they in effect would tell you it doesn't matter what you're trying to accomplish, and it doesn't matter how much money you have. Just answer the 50 questions our attorneys drew up to protect us from lawsuits, and we will quantify exactly how much risk you can tolerate. If that puts you at the red dot in this graph, that's the portfolio for you, whether you have $100,000 or $100 million, and no matter what you're trying to accomplish. Just put all your money in that red dot portfolio, which, by the way, is the market portfolio. And since we assume your preferences never change, you will hold this portfolio forever. No more decisions. Problem solved. On the other hand, there are many researchers in the field of behavioral finance who found that people don't understand these questions about risk tolerance. How could someone give meaningful answers if they don't understand the questions? Furthermore, it's been shown that their attitudes toward risk change dramatically, and usually at the wrong time. If this research is correct, risk tolerance questions are at best meaningless. So what would PMPT, postmodern portfolio theory, have to say? It would say investment decisions should be based on the investor's needs, not their feelings. The purpose of investing is to achieve some payout in the future. That's the goal. Beating the market is irrelevant. If the return on the market is 2% and you earn 4%, but what you need is 8% to retire with dignity, who cares if you beat the market? You're underwater. The critical information you need is what rate of return you need to earn on your assets to achieve that needed payout at retirement. We call that the desired target return, or DTR. Now, those are registered trademarks that cannot be used without our approval. Why? To protect you from those who would not calculate it correctly, as happened sometimes with my Sortino ratio. Now, here are the people we relied on to develop our version of postmodern portfolio theory. For those who want more details, here's 2 books. The first one I wrote with Professor Stephen Satchell at Cambridge University in the UK. However, neither book could have been written without my colleague and math professor, Hal Forsey. If you want to know just a little about the unknowable, you can go to Wikipedia and type in postmodern portfolio theory, or go to my blog, pmpt.me. Most wealthy investors hire active managers, and most large defined benefit plans hire active managers. So why do so many people believe you shouldn't hire active managers? I believe it is due to a flaw in the way most consultants evaluate managers. And when they do use active managers, it ends up corrupting your asset allocation decision. Here's how it happens. This graphic represents the output from Bill Sharp's Style Analyzer, and every professional has one. Your consultant says you should have a 10% allocation to mid-cap growth. So he hires a mid-cap growth manager. But the Sharp Style Analyzer shows this manager is only 25% in mid-cap growth. Then the consultant says, allocate 10% to large cap growth. But you already have a 4.5% allocation to large cap growth with the first manager you hired. Your most important decision has been corrupted, and with each additional manager, your asset allocation becomes even more corrupted. In the end, neither you nor your consultant know what your asset allocation is. Okay, your asset allocation has been corrupted, but in the world of finance, it can be uncorrupted. Suppose the bucket of green, gold, and black at the top of this graphic represent the asset allocation you want. Let's compare a portfolio with active managers and passive indices, the black shape on the left, with a totally passive portfolio shown as the green shape. Both exactly fill up all the buckets in your asset allocation. Which should you prefer? Voila! The arrow points to the black shape and says, black is more beautiful than green. Now, someone using MPT would look only at the mean and standard deviation of these two shapes and say, beauty is in the eye of the beholder. The green beauty has less return, but less volatility. And all volatility is bad, even if it falls above that DTR we don't calculate. So even though your black beauty has more return, it has more volatility. Therefore, black is no better than green. It's a matter of the preferences stated in that questionnaire that you filled out. This is like going to a doctor who makes a diagnosis based only on your temperature and blood pressure. PMPT says, if you knew what I know about these shapes, you'd think differently about which one is the winner. All volatility is not bad. Only the returns that fall below your DTR are bad because they cause the bad outcomes. This is the relevant measure of risk I said I would tell you about. It is called downside risk, and I first came across it in a paper written by Peter Fishburne at the University of Pennsylvania. Returns above the DTR cause good outcomes, so volatility above your DTR is not risky. The red rectangle shows the upside potential ratio. We developed this with Robert van der Meer at Groningen University in the Netherlands. We published it in the Journal of Portfolio Management 13 years ago. Our research has shown it has a far better prediction of performance than the Sortino ratio. We gave this upside potential ratio away in the first book we wrote with the source code. It shows the black shape has 30% more upside potential than downside risk, while the totally passive green shape has 10% more downside risk than upside potential. You don't get that with the Sortino ratio or any other ratio. Also, the black shape with active managers could add 180 basis points in any given year, and that is after fees. So why don't consultants calculate your DTR and the upside potential ratio? Well, some of them have told me people want simple solutions to complex problems, like target date funds. And as consultants, they give people what they want. PRI is in the business to find out what you need. We present evidence at conferences in the US, Europe, South Africa, and Asia. And we work only with those few consultants who understand our methodology and dare to be different. We do not deal with individual investors. This is our first attempt to speak directly to the investing public. We hope you will find it thought-provoking and helpful. Now we are going to look at a new way of adapting when things don't go as planned. Instead of framing portfolio management as a wealth maximization problem, let's frame it as a navigation problem. Before GPS, if you had to get from LAX to JFK, it would be critical for the navigator to determine the direction to your destination. After plotting a course and estimating the winds aloft, he might tell the pilot, "Fly a heading of 60 degrees." Well, inevitably, the winds aloft will be different than forecasted. So when blown off course, every navigator would plot a new course to his destination. Portfolio navigation is very similar. It assumes you need to get your assets from where they are to some destination point where they need to be. The critical thing to know is the direction to that financial destination. But instead of measuring direction in degrees, it is measured as a rate of return that must be earned on the assets in order to reach the projected payouts at retirement. We call that the desired target return, or DTR. The current market value tells you where you are. So when you know you're off course, there are three ways that people currently make adjustments. 1. Stay the course, hoping that the winds of fate will blow you back on course. That's called the buy-hold strategy. Rebalance. Well, that will get you back to the original asset allocation, and that would keep you in that blue cone. The last is liability-driven investing. That's what I did my doctoral dissertation on. This would deleverage by selling equities and buying bonds. But that is the opposite of what is needed here when you're below the DTR. That would put you below the blue cone. So how would portfolio navigation have worked if you started it when the market was an all-time high, like where we are now? I will share with you a case study. To test the efficacy of portfolio navigation, we purposefully chose to start right at the top of the stock market in 2007, just before the market plummeted 53%. We assumed a woman named Martha was 55 years old, wanted to retire in 10 years, and based on her annual income, her account balance in her 401k, and her annual contributions, determined that her DTR was 8%. The first time the DTR changed was 10 months later, when her portfolio declined 4% to $614,000. Notice this is not an attempt to buy on every dip and sell on every peak, like a market timing strategy. It is driven by changes in the DTR. The next increase in equity was 6 months later, when the portfolio value declined another $100,000, causing an increase to a DTR of 10%. Now, some people have compared this to doubling down in blackjack. Interesting, they use a gambling term to describe correcting the path to her goal. The last increase in equity was about 2 months before the bottom of the market. Equity was increased to 90%. Her portfolio was now down 25.7%, but remember, the market was down 53%. As the market rose, her DTR declined, and by the first quarter of 2011, her DTR was back to 8%, and her portfolio was $46,000 more than she started with. But what if she had just bought and held the S&P 500 SPDR? She would still have been down 7.3%, with a market value of $648,000 instead of $745,000. Remember, there's no such thing as a riskless strategy. We are operating in a world of uncertainty, so there isn't any knowing what to do. However, we believe that portfolio navigation is a professional way to manage that uncertainty. It has been a pleasure bringing our latest advancements in financial management to your attention. When I first started PRI, Dan Matroci was the general manager of the City and County of San Francisco retirement system. Dan was the first person to join our board of directors and support our research efforts. I'm sorry he couldn't join us today, but we are fortunate to have the woman he mentored and who became the executive director of that pension fund, Claire Murphy. Welcome, Claire, and thank you for joining us.
Good to be here.
1985 to 2010. A lot happened in that time. Tell us some of the things you dealt with and the changes that you had to deal with.
Well, that's almost 25 years that I served as the director of the San Francisco Employees Retirement System. But shortly after I took the reins, we began the searches for non-U.S. investment opportunities. And that was in 1986, and we selected both non-U.S. equities, primarily in the developed markets, and non-U.S. bonds, primarily sovereign debt. Over time, we expanded our real estate from commingled structures to investing directly in the ownership of properties. And a very large effort, which began in the late 80s and blossomed throughout the 90s, was our effort to engage in the area of private investing. So we began partnership investing at that point. We also had a huge expansion of assets during that 25-year period.
Tell me about that.
When I started, the plan had about $600 million in participant contributions and employer contributions to the plan. Over time, over that almost 25 years, we grew to be $16 billion in assets. And as a result, we moved from a strategy with a very limited number of external active managers, beginning with about 10 in total, raising to about 40 when I retired in the public markets.
What percentage of management was done actively versus passive?
A large portion of our strategies were, in fact, active strategies. For large areas, large cap, U.S. investing or European investing, we would have some passive effort. And to a large degree, and even today, the plan does maintain a staff-managed fixed income strategy. And at the time that I started, that was about 25% of the assets, and today it's a little under 20% of the assets.
You had a 401k type plan, I think. How were you able to protect participants from shooting themselves in the foot with that plan?
Our plan was called the 457 plan, the IRS Code 457 plan, the San Francisco Deferred Compensation Plan, and the retirement board selected active managers and passive strategies and provided extensive education for the participants.
We've come to the end of our time. Thank you for sharing your thoughts with us, and thank you for being here.
Thank you.
When we return, I will introduce you to some innovations in portfolio management. Thanks, Claire.
Thank you.
It is now my pleasure to introduce Dr. Sam Savage from Stanford University. Welcome, Sam, and thank you for coming.
My pleasure.
I really enjoyed your book, and particularly that first photo that I saw in your book. Would you explain that to us?
Well, this is a cartoon by Jeff Danziger of the famous story of the statistician who drowns in the river that is on average 3 feet deep.
Mm-hmm.
But in general, the law of averages is a law that states that plans made on average assumptions are wrong on average. This has been understood by mathematicians for centuries, but it's amazing that the public at large is unaware of some of these problems.
You gave an example of the misuse of regression analysis to forecast the future.
Well, right. The law of averages is particularly evil when you apply it to growth rates. So this is a graphic showing what everyone thought the housing market would do, and the white dotted line there is sort of a regression analysis if you apply all this statistical analysis to it without really thinking about where the market is going. And the next graphic shows what actually happened. And all hell broke loose just because of this error, really.
I remember it well. You propose looking at the shape of uncertainty as opposed to just a line of dots. What do you mean?
Well, statisticians have looked at bar graphs, really histograms representing the various range of outcomes for uncertainties. And the law of averages occurs when people replace that graph basically with a single number.
Yeah.
So on average, the market will grow at 7%. And people lock into that. I myself call this the shape of things to come. And you've referred to it as the shape of uncertainty, but we're talking about the same thing.
Yes. Are you familiar with, well, I know you are, he's your colleague, Bradley F.A. What do you think of Brad's work in trying to explain the shape of uncertainty or the future?
Yeah, so the theory of probability and statistics is powerful and elegant. And so is the steam locomotive. And they were developed at about the same time. At the engineering school, we're no longer teaching steam locomotion, but we are teaching what I call steam era statistics. Now, where Brad F.A. comes in is that he has really revolutionized the field of statistics by moving into from the steam era variety to what I call computational statistics. He invented something called the bootstrap, which ushered this in.
Yes, it's been very valuable to me.
And what's unusual about Brad is that he is completely at home in the steam era and works with that statistics all the time. It is magnificent stuff, don't get me wrong, right? A lot of powerful stuff there. But he's also pioneered this computational statistics and is very comfortable with it as well. So he's really been kind of a revolutionary figure.
I want to thank you for coming, and I want to thank all of our guests for being here, and thank you for watching.
This educational seminar on investing is brought to you by the Pension Research Institute. PRI was founded in 1971 at San Francisco State University by Dr. Frank A. Sortino.